So it is actually the party.
Okay, and I'm also going to mute everybody right now. Please, I will mute you. So if you have any question during the course of the training, just raise up your hands. There, we will give you time to ask the question. So to avoid noise at the background, I'm going to mute everybody now. Okay, so today's course, as you already know, is Certified Cost Professional, which is CCP, and Uche has already explained everything to you if you want to become a Certified Cost Professional. So in the course of this 3 days training, which is going to be like a sand crash course, and I think we already sent some videos of the previous one to some people already. So by now, today's lecture will not be a new thing to some of you because you received the previous video before now. So today we will be talking about the fundamentals of cost. We'll talk about economic cost analysis and investment appraisal. And maybe tomorrow we'll talk about cost estimation and budgeting and project stroke asset management. Then next tomorrow we'll talk about risk analysis and see how we can incorporate the concept of uncertainty in your cost. And if we have time, I will introduce technical paper writing because it's one of the requirements for you to schedule your exam. I hope I'm very audible. I hope you can hear me very well. I want to confirm that.
Oh, yes, you are audible.
Okay, fine. Okay, fine. So now, when somebody should ask you what is even cost engineering, cost engineering is an element in certified cost professional. Why cost professional is cost engineering is, let's try to avoid noise, please. Noise. Try to mute your distance. So when we cost engineering is a segment in certified cost professional. That is why you also see one of our advert, cost engineering and financial analysis. That is a sub-module in this certified cost professional. Certified cost professional is beyond cost engineering. We also talk about manufacturing cost, production cost, and a lot of things. Now, what is cost engineering when you are just, why do you really want to become a cost engineer? Is the application of scientific principles to the problem of how do you plan your cost? How do you schedule your cost? How do you carry out cost estimation? And how do you carry out budgeting? That was why even in the Bible, it was written, who among you who want to build a tower will not first of all sit down and calculate the cost? So that if you don't do that, if you have started your building anyhow, you will not be able to finish it. People who are passing by will be laughing at you. So that is why estimation is really, really very good. So we also talk of how can you optimize your costs when you are surrounded with a lot of constraints, and how can you control your project through project progress measurement and performance measurement. Then from there, you also appraise an investment. You don't just go into any project, but you should be able to appraise that project. And we'll be using a lot of Excel application during the course of this training. And further, you learn how to build a likelihood, chance, probability around any uncertainty. And you simulate risk analysis through expected monetary value and decision tree. And if we have time, we'll simulate it using Monte Carlo simulation. Now, as a cost engineer, what are your roles? You should be able to be a cost estimator. For example, the QS are not cost professionals, they are cost estimators. Estimators are different from cost professional. Why cost professional is also an estimator, but has a broader knowledge of cost engineering, QS is limited to BOQ. Give me the extraction of the quantity, allocation of the prices, then you come up with a total sum of money. But when you're talking about appraiser, cost control, and risk analysis in cost, they find it very difficult. And because we have trained a lot of QS in this same course. then you should be able to carry out all the cost control. When you have a project with multitask, how can you control that project to know your progress, to know your performance? We'll be talking about all these things in the course of these lectures. And you should also be able to carry out project evaluation. But if we have time, which I doubt, I will also introduce you to project valuation, though we have a separate course for this, which is project financing and valuation modeling. That is how you really value your project. All those who are into bonds, into share, you know, when you can purchase your share at premium, when you can purchase at discount, all of them are embedded into this valuation system. Now we are starting with cost. If I should ask you, what is a cost? What is a price? It might look somehow, why are you asking me what is a cost, what is a price? So there is actually a difference between cost and price. So the cost is the value of an activity or an asset. Cost is to the producer or to the seller. For example, if I'm a producer of bottle of water, the cost of producing that bottle of water is my cost. When I build in my profits on top of that cost, it will give me price. So cost plus profit will give you price. Why price? If the purchaser, if the person who buy the product want to pay, that person, the buyer will pay the price, but the producer will give the cost. So that when the buyer purchase your product, what he's paying you is your cost of production and your profit of doing it. So why, in the simple definition, why profit is to the buyer, then cost is to the seller. Another thing that confuses a lot of professionals and a lot of engineers as well is what we call profit margin. A lot of engineers don't actually know how to factor in profit margin to their project or to factor in what we call markup to their project. At this point, I will give this little demonstration and let's make it interactive, then let's get the answer right. Assuming all of us in this training, we are all cost professional, and a client approach you that you should come and help him to construct 10-meter length of a road. And the cost of constructing that 10-meter length of road is $100,000, all inclusive, whether indirect costs, whether tax, any other thing, all inclusive is 100,000 naira. Then when you estimate the cost and give the cost to your client that everything is going to cost you 100,000 naira, the client now said, okay, add something to this 100,000 naira so that when you finish the work, you will be able to get a profit of 10%. How much will you add to that 100,000 naira? Is there anybody who can give us that answer quick?
10,000 naira.
100,000, 10,000 naira. Okay, any other person supporting us?
100,000.
100,000. Yes, add something to 100,000 so that when you finish the project, you will get a profit of 10%. So how much are you adding?
It's one.
Somebody said it's 10,000, which is
1,000.
10,000. Somebody said 10,000, which is 10% of 100,000. So any other person who can help us to contribute?
Yes, it's 10,000.
Okay, fine.
10,000.
10,000.
Okay, fine.
10,000.
In ideal situation, that is how all the engineers, that is how they have been calculating it. Even the QS, that is how they have been calculating it. But unfortunately, it is very wrong. That is not the way you should do it. When you add 10,000 naira to that 100,000, everything will become 110,000. When you finish that project, the profit you will get at the end of the day will not be up to 10%, because you don't understand the difference between profit margin and markup. when I ask you to add something to that 100,000 naira, what I am telling you is that please mark the 100,000 naira up. Mark it up so that you will get a profit of 10,000 naira. Let's try and mute ourselves, please. If you have a question, you can signify by raising up your hand in the chat box. Then we will.
Sorry, Engineer Sunday, you're muted.
Okay, can you hear me now?
We can hear you now.
Okay,
We
that
can hear you.
that is actually the concept. Now, you remember in our elementary school then, in primary 6 or primary 5, we were taught profit. Profit is equals to selling price minus cost price divided by selling price. On the other hand, markup is selling price minus cost price divided by cost price. What is the difference between the two? Both of them have the same numerator, but when you check the denominator, why profit is related to selling price, the markup is related to cost price. So what does that mean? Is that profit is a function of your selling price, while markup is a function of your cost price. And markup, one thing you should know is that markup is always higher than profit margin. At this point, I will illustrate that concept in Excel, then we'll come back to our PowerPoint. Let's see my Excel sheet. I'm coming on, try to see my Excel sheet. Can you see my Excel sheet?
No.
No.
Negative.
No, we can't.
You can see it now. Can you see it now?
Yes, visible.
Yes.
Okay.
But we
Now-
can see it now.
Okay, fine. So now let me do something here. Let's say, as we discussed just now, this is the cost of your project. Let me zoom my screen so that you can see me very well. As we said just now, this is the cost of constructing the road, which is 100,000 naira. And somebody said just now, when you add something, for you to get a profit of 10%, the guy said we are supposed to do it in this way. Let's say 10% of this, which is giving us 10,000, and the selling price, which is the final price, will not be this plus this. That is what we are, all of us agreed just now. Now, let's see the concept. We were told that percentage profit is equals to selling price minus cost price divided by selling price. If I should follow that formula, selling price minus cost price divided by selling price. If I should follow that formula, I will not get equals to, what is my selling price in this point?
110.
Okay, I will 110 minus my cost price is the 100. Then divided by the selling price, which is this. If I make it percentage, I'm having 9%. What this means is that if you do it the way all of you agree, when you finish this project, you are going to end up making a profit of 9%. Assuming you lost 1% of 1 billion, assuming your project is 1 billion and you lost 1% of it, imagine how much you have lost just for not able to really understand the concept, the difference between markup and profit margin. Now, on the other hand, markup is selling price minus cost price divided by cost price. It's a function of the cost price. In that case, I will come my selling price minus my cost price everything divided by the cost price. This. If I do it percentage, I am getting 10%. You can see what this one means is that what you have done, you mark your project up with 10%, and you end up getting a profit of 9%. For me to get a profit of 10%, what you will do, you will now use this formula, your selling price, which is your final price, is equals to your cost price divided by your percentage markup. 1 minus your percentage profit. Where your percentage profit is the 10% we have here. Where the cost is this 10,000. So if I want to do it in such a way, I will now make my own to be the cost equals to the cost, which is 10,000, divided by 1 minus 0.1. 0.1 is 10%. I would give equals to. This is the amount of money you will give as your final selling price. Instead of using 1110, it's supposed to be 1111, so 1100. So this is your final price. So let me use this one instead of using this, instead of using this 1110, let's use this now as our selling price and see what we will get. If I just come here and change this one to this, I'm having 10%. You can see when I use this, the percentage profit automatically comes to 10%. That is what it's telling you. Please just give me a little, let me, whether this is one of the trades. Very sorry, it's one of the candidates that is having challenges. Okay, now what does this thing tells you? If I want to find the markup that I'm supposed to mark this 10,000, 100,000 up to get a profit of 10%, I will come here as well. I will change this one to this. I will get 11%. What it means, when that guy asks you to add something to your cost, what he was asking you is that please mark it up so that you can get a profit of 10%. So your percentage markup is always higher than your percentage profit. So when the guy asks you so that you will get a profit of 10%, what will just come at the back of your mind is that the percentage you are going to use to mark it up must be higher than what the percentage profit. So to mark it up, you will not use this formula. This formula will not give you your final selling price, so that when you subtract this away from this, you are getting the amount of money you have added onto it. And that is what you divide that gives you the 10%. So I hope if this is the only thing you will learn today, I think you have achieved a lot of things already, because based on this is how, that is why with my former company, they were saying, no wonder, when I talked to them, they were saying, no wonder the POS will be telling us we are making profit, but we are not seeing the money. It's because we are not doing it in the right way. Why is it important? It's not just because you want to know it. When it helps you to determine the amount of profit you are expecting from your product and how you will be able to mark up your selling price. Assuming you are a business owner who own water factory where you will be selling pure water, and you already estimated the cost, and you already ask yourself, this business I want to do, I want to make a profit of 10% on top of it, and you mark it up wrongly, you will be the one that will be at loss. So at this point, is there any question here now before we move to the next course of our training? Any question at this point? I hope it's very understood by all. Okay, in the absence of no question, I assume all of you understand this concept. So as from today, try to be doing it in this way, unlike the former way where you will just factor in the profits directly. Okay, let me go back to my slides. Now let's talk about the different concept of cost. Costs falls into three major categories. In anything we are doing, it's either we are using material, it's either we are using people, it's either we are using ordinary administrative expenses. So the cost of the material for executing your project is the material cost. The cost of people you are going to use on that project is called the labor cost. And any other administrative expenses that are not attributed directly to the laborers or to the materials, but they are also expenses you have incurred in the cost of the project, is what we call the overheads. So these are called the element of cost. We have the material cost, we have the labor cost, we have the expenses, which are overheads. Material costs can also be further divided into direct and indirect material costs. Labor as direct into indirect costs, and expenses can also be called direct and indirect expenses. That will not take us to the different cost structures. When we talk about structuring of costs, in other words, different types of costs, so that we use that to understand at what point, which cost are you dealing with at every point in time. One, we talk about the direct cost. The direct cost is the actual cost that is traceable to either a product or a service. Indirect costs are mostly overheads. Indirect costs are costs that you cannot trace directly to a product or to a service. For example, you want to buy a computer at Computer Village in Lagos. When you get there, you price the computer. How much is this HP computer? They say it's 200,000 naira. You bring out your money, you pay for the computer. As you want to go, you just feel like, oh, let me buy a bag to be putting in the computer. You purchase a computer bag. In the course, you ask the guy, please, do you have AutoCAD or you have Civil 3D? Please help me install that software. They say, oh, guy, you give us like 1,000 naira. You give them the 1,000 naira. Oh, do you have a mouse? Let me buy a mouse. You purchase a mouse, and at the end of the day, you assemble everything. Assuming when you were leaving home, it was your wife who gave you your money, and your wife gave you 250,000 naira. When you return home, when your wife asks you, how much did you buy this computer? There is a high chance that you will tell your wife is 200,000 naira, because that is the actual cost of purchasing the computer. If you then tell your wife that the cost of the laptop computer is 200,000 naira, my wife will not say, oh, thank God, but I gave you 250 today. Where is the remaining 50,000? If you dip hand into your pocket, you will not see the remaining balance again. Why? Because you have purchased computer bag, you have purchased you have installed software in the system, and you have purchased mouse. That 200,000 naira that is traceable directly to that computer you have purchased is what we call the direct cost. And the other ones that you cannot trace to the computer is what we call the indirect cost. And why is it important, the indirect cost, is that indirect cost is difficult to monitor. In the market, if you actually want to negotiate the price of your computer, is the 200,000 naira you will be negotiating. Because it is difficult to really control indirect costs, that is what is constituting a high cost into a company balance sheet. And if you don't watch it very well, those are what cause a company to collapse. That is why when you go to some bank, if they want to print bank statement for you, they don't put A4 paper on their printer. They would have sent the document to know the numbers of pages before they put in the A4, because they might send a wrong document in error and the printer will pick it up. For every one A4 paper you are wasting a certain amount of money. That is why when you are a worker in your company, you just go to the company, you send anyhow document to the printer, you print and it's a wrong one, you tear them, you dust them away, or you go to the toilet, you just on the light is on 24 hours, you forget, because it is not your own, because you are not the one to pay the bill. So that is why it is a good advantage that we put eyes on the indirect cost. Even your family, if month end you bring out your money and give it to your wife, if you are not monitoring your utility bills and any other unexpected expenditure that are coming that you are not accounting for, those are what makes a man to even be wrecked, not even the house rent you are paying, not even the car you have purchased, because these are in the direct cost. So the direct cost should actually be watched for. Now, let's talk about fixed cost and variable costs. Fixed costs are costs that doesn't change with the numbers of outputs you will have. For example, if you rent a flat in Lagos, let's say is 800,000 naira per year. Whether only you is living in the house, whether you bring in up to 5 friends that all of you will be living in the house, it doesn't concern the landlord. It's not a function of how many people are living there. It's fixed is fixed. So that type of cost is what we call fixed cost. But the other ones, the variable cost, is a function of the numbers of outputs that you are delivering. For example, okay, if only one person is living in this apartment, you are going to pay so amount of money. If 2 people are 2, you pay so amount of money. If 2 people are 3, you pay so amount of money. These are variable costs. We also have semi-variable costs. These are costs that has element of fixed and element of variable costs. Then we also have what we now call total cost. By the time we add the total cost plus the variable cost, by the time you add the fixed cost plus the variable cost, you have the total cost, or the direct cost plus indirect cost. We want you to understand this concept, and we'll come to our Excel sheet shortly, where we'll be demonstrating a lot of practical demonstration to you people. We also have one important concept, which is the marginal cost, and which is the average cost and the marginal cost. The average cost is the total cost divided by the numbers of outputs you are producing. When you have the, for example, if you rent the flat for 800,000 and 10 people are living in that flat, if you want to share the house rent in a year, you divide the 800,000 by 10 people living there. You are having 80,000 naira. So that 80,000 naira is your average cost. That average cost helps you to really know at what lowest level a unit of your production will possess. That will help you after your break-even point you will be able to change the price strategies. We'll be coming to that very shortly. So another thing I will show you. Sorry, I think somebody is having issue with just give me like a second. Somebody's having issue to join. Let me. Let me see, but when you send me an email, I will respond to the person. Okay. Now, can you hear me? I hope you can hear me.
Yeah, you're good to go.
Okay. Now, we also have what we call prime cost. Why we take time to be explaining all this, because in exam, they will be asking you all this in your CCP exam. Whenever you hear the word, they said prime cost, what will come to your mind is that direct cost. When you add up all the direct cost of your project, you have what we call the prime cost. That direct cost is a direct material cost, direct labor cost, direct expenses. When you add all of them together, you are going to have what we call prime cost. Prime cost does not include anything indirect. Take note of that. Then another important thing that will interest you is what the marginal cost and incremental costs. Marginal cost is very important in our daily life in the sense that is the cost difference by trying to increase your production by one more unit. If, for example, you are producing at a certain capacity, and because of excessive demand from the customers, you want to expand your capacity. What will happen is that when you increase that your capacity by one more unit, how does it affect the price? At that point, you will be able to know whether you should continue with your expansion or you should remain in your current capacity. Because if you decide to expand, the marginal cost will go down. You will not be able to scale through in the market. For example, many physical business, by the time you are trying to expand, your marginal cost will be increasing correspondingly. A point will come when the marginal cost will be far higher than the marginal revenue. At that point, the company will be at a loss. If you continue in that business, you will fold up very soon. That is why you see that the Dangote company is not in everywhere in Nigeria. You can't find it in all local governments, because by the time it tried to expand the company to another inner part of Nigeria, the marginal cost will increase proportionally. That is why you see that bank, they don't have all their offices in all local governments, because the more they try to go interior to establish a branch, the more the marginal cost is increasing and the more they are incurring loss. But let's see digital marketing like Facebook, like WhatsApp. If somebody should sign in into Facebook today, it doesn't, Mike doesn't incur additional cost for another person to enter into the market. No. So in the digital marketing, as expansion is going on, the marginal cost is tending towards zero. That is why you can see they are enjoying a high scale, a high profit in the business, because the more they expand, the more the marginal cost is approaching zero. But unlike the conventional marketing, when you try to expand, the marginal cost will increase. So when we finish this, I will take you to an Excel sheet where I will demonstrate the concept of this marginal cost with you. At that point, you should know the limits at which you cannot go beyond. If you go beyond this, you are going to incur loss. We also talk about sunk costs. One thing you will have at the back of your mind, anytime you are doing any cost train, any cost exam, and you see the word sunk cost, the thing that will come into your mind is past cost. These are money already expended. These are costs already incurred. Why it is called sunk, it doesn't reflect in the company balance sheet because it doesn't add anything to the decision the company want to make today. For example, as a guy, you already pocket your money, your pocket, and you are going out to just purchase something. As you are just passing along the way, you see one fine babe along the road. You try to, babe, how are you? This in the course of discussion. Oh, I just want to take a snack. With shave, you just remove part of the money. You buy the snack for the guy and you go. As soon as the guy is leaving and you are going forward, you are saying, oh boy, I have incurred additional cost already now. Any decision you want to take at that point, you will not consider that money you have spent on that guy. It doesn't affect the decision you want to discuss now. It's already a past cost. It's already a past cost. If you want to even calculate your expenses today, shame will not even allow you to include it. So they are past costs. They are past costs. So they are gone. They are gone. They don't reflect on the company balance sheet. So that is it. Now, the next thing is opportunity costs. Opportunity costs, remember in our economics in secondary school, we were taught opportunity costs, and we never know the importance of the opportunity cost. Opportunity cost is actually, in a simple term, what you forgone to achieve a particular thing, and what even brought the necessity of opportunity cost.
Okay.
Inherently, human wants are insatiable. Because you don't have the means to satisfy all what you want in life, you have to draw up a scale of preference, itemizing the priority and the order in which you need this item. If you pick priority 1, which is the most important to you in the list, then you allow order to go. So the opportunity cost is the foregone alternative of whatever choice you make. Some of you today are supposed to be in the office. Some of you today are supposed to be in one place or the other, doing another thing that can even fetch you money or otherwise. But the opportunity cost of you coming to this training we are now is the cost of those things you have allowed to go. Why is it important? That you should use it to make a decision. Before you should allow another thing to go, you should weigh the importance of the two. The one you are choosing should outweigh more than the one you are allowed to go. Either in importance, either in value, either in satisfaction, whatsoever, the value of that should be more than what you are forgone. Now, a question is, if you have 2 items, item A, item B, and the cost of them, let's say 5,000, and in your scale of preference, item A is higher in value than item B, then you decided to choose item A. The opportunity cost of item A you have chosen is the cost of item B you are allowing to go. But when you have multiple items, are you not seeing my screen?
I can see.
Yes, I can't see anything.
You can't see my screen? I think
I can see your screen.
okay. I think it should be from his side. Let me reshare. This is my screen. Should be from his side. Okay. Now, okay, we can see it fine. Now, when you now have multiple items, item A, item B, item C, item D, item E, and you decided to choose item A, what is the opportunity cost of the other item you are allowed to go? Who can answer that question for me? You have item A, item B, item C to E, and it's arranged in order of importance. Item A is higher in the priority. and you have decided to choose item A, what is the opportunity cost of the other 4 you are allowed to go? Who can tell me?
Is the average of the cost of the other 4.
Okay, fine. Any other person who can try?
Is the cost of the B to E.
Is the cost of B to E. Okay, fine. Any other person who can try again? Hello? Okay.
Yeah, I said is the cost of B to E.
Okay. Is there anybody who can try again?
Is the cost of the other
The
things?
next, yes.
Is the cost
Hello?
of what?
Is the cost of the next priority.
Okay, good. That is what I want to confirm. So the opportunity cost in this case is not the summation of the cost of the other item, but the cost of the nearest item to it in importance. If we choose our priority to be A to E, so the cost of item B should be the opportunity cost. So take note, these are very exam questions. So another thing we talk about is hard cost and soft cost. In engineering, we have different components. For example, if you want to design a building, you have the cost of the slab, the cost of the beam, the cost of the reinforcement. All those costs of the physical component of the project is what we call hard cost. Then the other cost is cost of, for example, cost of approval, cost of facilitation, and other things. These are soft costs. We also have recurring and non-recurring costs. Costs that keep on repeating itself, like light bill, they are recurring costs. While the cost that is one time, they are called non-recurring costs. We also have what we call cash cost and book cost. Book cost is the cost as recorded in the company's ledger. For example, if I want to buy a laptop, I record in the company's ledger that the laptop is 200,000 naira. And I was given 200,000 naira. So when I get to the market, I bought the computer 180,000 naira. So the actual money that left my hands is what we call the cash cost. But the one recorded in the ledger is what we call the book cost. So that is the difference between cash cost and book cost. We'll get what we call way of structuring cost elements, which is we just use it. Maybe under exam, they ask you what are the ways cost element can be structured. Is it be through estimating, through trading, through forecasting, through life cycle costing. But we will be dealing with these ones today, one after the other. During estimating, we'll be talking about that. During forecasting, we will also talk about that. Then we also can talk about trend behavior during forecasting before we talk about life cycle costing. Now, another important thing that is important in a cost is cost accounting. Cost accounting is a historical reporting of the payment, expenditure, and the cost of a project. Historical. That is different between cost accountant and management accountant. They have what they call cost accountant and management accountant. Cost accountant are the ones that are looking into the historical information. They are the financial accounting. The financial accountant, they look into the historical information of the company and they report about the company. But the management accountant are the accountants that are doing the day-to-day operation of the company financial statements. So we'll talk more in that one when in another module during project financing and evaluation. So now, the another important thing I will discuss here before we go to the other ones is the next module is what we call activity-based costing. Activity-based costing is a very important method of costing that helps you to break down your costing to the lowest level of work data structure. For example, when we are doing your BOQ, you break down your activity into different tasks and assign costs to them. That is already activity-based costing. They want to help you to trace which cost is associated with any activity or any personnel. Why is it important? Is that in a company, if the federal government should apply this method in government ministry, you will see that a lot of people will be sacked. Activity-based costing helps you to identify redundancy in your organization. And it helps you when you want to drop up some people who are not functioning. Activity-based costing will help you to determine it. What it does is that it traces every expenses to a particular activities or personnel. Question, why are we spending this? Why is this expenses coming from this person? Then we will value it. What is the volume of work done? When we were in Germany, with me and Uche, when we were doing our master program in Germany, there we were working in a Mercedes-Benz company, maybe during the weekend. If we go there in the morning, they will give us a clock. We clock. We are going to work 8 hours in a day. We clock. We enter there. So when it is 8 o'clock exactly, then we clock. We go back. But in the course of the 8 hours and the work finished for that day, and there is no more work to do, the next day they will call you and say, please, there is no more work, you can go home. We will come back and clock. The numbers of hours you clock is what they will pay you. But in Nigeria case, maybe you can come to office in the morning, you just yawn throughout. The next thing you stroll out and buy food and chop and come and sleep and snore. So who is paying for all those idle times? So that is what activity-based costing helps you to identify in your organization and know which area that are not profitable, which areas are not functional, and you will help you to crash that area and remove it. And it's also applicable when we'll be doing value engineering and value analysis. Maybe if we have time on the last day. So now we are talking about work breakdown structure. We'll talk more about this during scheduling. We'll talk about this. So the next module I will talk about now is, I think I will just go to the next one. And from there,
Hello, sir.
Hello.
Hello, sir.
Yeah,
Please,
you have
can
a
we
question?
talk? Sorry to so this other part that we're flipping through. These
Yeah.
steps to just go back. Steps to cost pricing process.
Yeah, we will talk about it during pricing.
Okay.
That is right. The ones that are, I want to take everything so that it will flow easily. No. And I have already shared this material with you people, I guess so. So
No, the material is not part of what you said. It's YouTube channel that we have there.
oh, okay, I think those are the late people, but the previous one, I said those are the early ones. But we are going to share, maybe I will share the material through here later so that all of you can have access to it. Now,
That will be good.
yes, I will share the material. What I'm trying to really see, there are some theory that you can understand on your own, and I will be particular about most of the calculations that you will not be able to get easily. So at this point, I think I will continue from here now. But at this point, we are in 4:05 now. I'm going to give you people 5 minutes so that you can stand up, drink water, stretch your waist, because it's not good that we sit for long with this our old age. Then we come back exactly 4:10. I think it's now 4 minutes. 4:10, we come back exactly, then we continue from there. Thank you very much. See you in the next 4 minutes, yes. Okay, so just now, before I proceed, we talked about the concept of marginal cost and marginal revenue. I think when we finish, I will say how to share some of this Excel sheet with you people. So let's see when we talk about marginal cost just now and marginal revenue. Now, when this is an example case before us, first of all, what is marginal cost? Marginal cost is change in cost divided by change in quantity. Marginal revenue is change in revenue divided by change in cost. So let's see why they are important to you as a cost professional. A cost professional, what you should have at the back of your mind today that you are not just a person who prepare BOQ. You are not just somebody that will just be preparing BOQ or BEME. No, you are more than that. You appraise investment, which
Engineer Sunday, sorry, I just came back. I don't know whether you've covered much ground.
No, we are just starting now.
Thank you.
Okay,
Please start afresh.
It is not, you will know, you are not a cost estimator that when you finish, you just want to be doing BOQ or BEME. No, it's far beyond that. You should be able to appraise investment. You should be able to control projects, which we'll be talking on the third day, which is what I experienced when I was in Germany. When I was coming back to marry, I overrun my budget. But when I want to do my mother burial, I control the budget and I was within limit. So you will see how to run all this. It doesn't really mean it's a project. It must be a building or an engineering work. In anything, birthday, marriage, burial, a lot of things. So let's see how marginal cost and marginal revenue helps you to avoid expanding anyhow so that you will not run at a loss. Marginal cost, as we know, is change in cost divided by change in quantity. Marginal revenue is change in revenue divided by change in cost. Let's say a case study. Annually, a man produces 10,000 tires annually. And the cost of the 10,000 tires is 5 million annually. If we want to calculate the unit cost, which can also be called the average cost, unit cost stroke average cost, it can also be called average cost, is equals to the total amount, 5 million, divided by the numbers of tires you are producing, is 500. So the cost of one tire is 500 naira. Because of that, many customers were coming. The market experienced boom. There is excessive demand. And because of that, the man want to expand the production capacity. And the new production capacity is now 15,000 in a year as against 10,000. And the annual cost is now 7.5 million. If we also want to calculate the unit cost or the average cost, it will still give us 7 days divided by the quantity. We are still having 5. What does that one tell you? It means that whether the man remain in his current production or the man expand his production to 50,000, the unit cost, the marginal cost is the same. What that one means is that the man is not benefiting from expanding, but it's only just satisfying his customer demand. But it doesn't change anything. So the marginal cost still remains the marginal cost. Assuming that at this point, the selling price before, when this man was producing at this unit cost, the selling price is 515 naira. And when he expands, the marginal cost still remain like this, and the selling price still remain like this. So the man is still good to go ahead with the business, with the expansion, because he is still making a profit of 50. But let's see a scenario whereby the expansion is 50,000 in quantity, but the cost is 8 million. In that case, you will divide the 8 million divided by this, you are having 820. When you are having this 820 at this, when you are having this 820 at this point, you can decide to calculate the marginal cost of these are unit costs. You can decide to people say, what is now the marginal cost of this expression? What is marginal cost? Marginal cost is equals to change in cost divided by change in what? A quantity. That's what I said just now. What is change in cost means the new cost minus the original cost. The new cost is now what? 8 million. The original cost is what? 5 million divided by the quantity. The new quantity is 15,000. while the new quantity is, original quantity is 10,000. The marginal cost is 600. If the selling price is still remain 550, what will happen to that company? The company will not be able to recoup back all the marginal cost because the revenue is more than the marginal cost. Now, let's make it the revenue case. This is already the original one we have discussed. Less the total sales, less the units. When this guy was producing, this is exactly what I explained before. The unit cost is 500. Assuming the unit sales, that is the cost of selling one, is 600. Then for you to get your total sales, would have been the unit cost times your total quantity, which will give you 6 million. You are selling 6 million, you are producing at 5 million. You are making a profit of 1 million. Now, when you expand and the quantity remain like this, you are still selling, your unit cost is this, and your unit sales is still this. Your total selling revenue will not be the unit sales multiplied by the quantity. You are having this as your new price. Now, if you want to calculate the marginal cost is 500, the marginal cost is will not be equals to the new cost. Where is the new cost? 7.5 million minus original cost, which is 5 million, divided by change the quantity 15 minus the original quantity. The marginal cost is 500. Let's check out the marginal revenue. The marginal revenue is your new revenue, which is 9 million, minus your original revenue, which is 6 million, divided by your new quantity, 15,000, minus original quantity, which is 10,000, is 600. Now, your marginal cost is less than your marginal revenue. Your marginal revenue is greater than your marginal cost. What does it mean? When your marginal revenue is greater than marginal cost, which is the case we are now, what is telling you is that you are not producing enough goods. Increase your capacity until profit is maximized. You are not, what it means is that you are not maximizing profit enough. Expand. So when you expand, the point where profit is maximized is the point where the marginal revenue is equal to the marginal cost. When the marginal revenue is less than the marginal cost, it means that you are producing too much. Please reduce your quantity until profit is maximized at the point where MRO is equal to MC. Then when MRO is equal to MC, that is the point where profit is maximized. If I come to this chart, you will see this chart. This is the demand. This is the marginal cost. This is the marginal cost. This is the average cost. So this is the marginal revenue. This point here, you are saying here, where MC is equals to MRO. If you trace it down, this is where you have the optimized quantity. And if you take it to this place, this is where you have your optimal profit. That is the point where you are maximizing your profit and you are maximizing your quantity. So when it is below, you are not producing enough. When it is above, you are producing too much. So that is the concept of marginal cost and marginal revenue. So at this point, I will go back to my slides again. Do you have any question here? Okay, if there's no question so far, I will go back to my slides. Now, I want to talk about step cost pricing process, which the guy said we should discuss before. Please let me check if I'm recording. Okay, thank God. So now, in asset acquisition, if you want to talk about asset acquisition, if you want to purchase an asset, so I'm just saying whether it's here is the best place to discuss this, but anyway, let me discuss it. Is your in capital structuring, we have what we call asset, we have what we call debt, which is also, and we have what we call equity. Equity is the shareholders' contribution, while debt is the money you borrow. When you combine the two, you have an asset, which is what we call majorly the accounting equation. Now, if you want to purchase an asset, you have to know some financial ratios. That financial ratio will help you to understand whether you should go ahead or you should not go ahead. And it also, when you go to company's balance sheet, it will also help you to really understand the financial nature of that company. We are just discussing it shallowly here because it's supposed to be in project financing. But what is return on assets? If you have an asset, say an equipment that you are putting into lease, or a building that is bringing in money for you, you have to calculate. Okay, Uzuma, you want to ask question?
Yeah, I think this slide is not the beginning of this step, because I have it. So you can start from the beginning of the step, please.
Let me see it. If what I'm trying to know, because it's like it's not flowing well for you, Abi. I'm trying to say
not really.
No,
that really flows well for me, but because of the benefit.
No, that is
because of the benefit of the person that asked that question.
No,
that
is where it started from. For example, this is where we end activity-based costing. When we finish, we talk about what breakdown structure, which it doesn't really mean we talk about how to break down activities.
Fine. The next slide, yes, this is where it starts.
This
is where it starts.
Input,
this is where it starts.
Transformation and mechanism. Okay, let me just tell you, I don't think it's, but let me just explain it here to you so that we move to that one. Now, if you want to acquire assets, or if you have already entered into business, you will know how to determine your pricing system. That pricing system helps you to know how you are going to incorporate your profit into the business and how you are going to change your profit system when you already break even. For example, you will see that some company will be selling the same product at a lower price and some will be selling at a higher price. Have you ever asked yourself why? Is it that the new one want to get more customer? And if you see it, is majorly the new ones that are trying to sell at a higher price. The reason be that when you initially start your business, you make sure that the pricing strategy will be high. In the sense that this cost we are teaching you now, that we are collecting, you people are paid 25,000 naira. In 2019 and 2018, it was 150,000 naira. So we brought out the module when we came back from Germany, and it was 150,000 naira. Even the physical, when I teach NLPC, I train NLPC staff on this, about 20-something people from NLPC. It was the money was even more than what we have charged. So, but the same thing is what people are benefiting now, maybe for 150. Why? We just feel, let's just help the people. We already got the money we need to get from this training and something of that nature. But that is where you will see JK Michael that are doing maybe some modules, not, let me say, not related to this one really. They are charging 250,000 naira. What does that one mean? At the point where you have breaking even, that is the point at which the money you have invested in the business, you will be able to get them back. You can change your price strategy. It says that we have already benefited, all the money I have invested, I've gotten them back. So if I reduce the price of my product, I will get more customers and we also scale. So that is the concept of how you do your pricing strategies. And they are based on what, that's what you see just now, historical information from what you have been doing before. And maybe from, if people want to change another price strategy, they will tell you, go and give us the price quotes of different companies. From there, you can use that one to benchmark your own. But from here, these are just techniques you just need to understand here. But what I'm trying to discuss here is these ones, when we are doing cost engineering, we understand them more so that we will not be wasting more time here. So when we are talking about cost estimated tomorrow, cost budgeted tomorrow, and cost forecast, where we'll be using parametric estimating and all, you will understand them more here than just reading it to you, because I am not really used to read the PowerPoint. That is why you see I skip them. But when we come to the main module tomorrow, when we are doing the application in the Excel, you will understand all these concepts. So now at this point, let's talk about return on asset and return on investment and net profit margin. We have already discussed our net profit margin just now. We will talk about return on asset and return on investment. Return on asset is the asset you are putting into use. At what rate is it generating profit for you? The higher it generates profit, the better that asset is for you. The other one is return on investment, ROI. ROI means that this investment you have put in yourself, at what rate is it generating profit for you within the life cycle costing of the project? When we'll be talking about investment appraisal, when we come back from 5, you will be saying return on the investment and internal rate of return. That internal rate of return and return on investment, they are similar. The difference between them is that return on investment is based on the life cycle costing of the project. If the project is for 3 years, return on investment is dealing with that 3 years. But internal rate of return is dealing with annual basis. So that is the difference between internal rate of return and return on investment. Both of them show how the business is generating revenue. But why IRR is annualized, the other one is within the total life cycle of the project. Now, let's see how to calculate that. I think we have some calculation about that. Now, return on investment. Return on investment means the profitability of money invested in the project. As I said earlier, the higher, the better. Return on investment is equal to profit divided by cost. Let's see an example here. As a house flippers, you purchase a house at the court house auction for the $75,000. This is the cost. And you spend $35,000 in renovation. After sales, expenses, and commission, you sell the project for $116,000. What is your ROI? This is the cost of the building you just purchased at the local level. And let's stop that noise. Let's stop that noise. This is the cost of purchasing just a poor building. You renovate it for $35 million and $35,000. And when you finish everything, after your expenses, you sell it this. Now, what is your return on investment? If you add this and the cost of renovation, you are getting the total cost of that building. That total cost of that building will give you this cost of 110,000 naira we have here. Now, return on investment will now be the net profit divided by total investment. If 110,000 is your cost and your sales is 160, your profit is this minus this will give you 15. So when you net it as 15 divided by cost, you are having 0.545, which is 45%. What does it mean for ROI to be 45%? It means that where you are spending money at the rate of 100%, the reward you are getting back is 45%. the additional benefit you are getting back is 45%. That is, for every 1 naira you are spending, your return is 45 kobo. That is what it means. So a business that has if you have 3 businesses that you want to compare, and the first one has ROI of 45%, the other one 50%, the other one 60%, the higher one is the one that you would prefer. That is why on exam day, they may not bring question like this for you. They will tell you 3 projects are being appraised. The return on investment of each of them are this. Which of the project will you choose? So the one with higher ROI is the one you would prefer. Note that. Another one, again, I think we have discussed this one already, the net profit margin from what we have discussed already. You can see why the profit here, the profit is netted with cost price. You can see the profit here is netted with cost price. This is almost like the markup we have discussed today. But you can see the profit margin here is netted with total revenue, which is our profit. Now, the ones I will talk to, the one I will not discuss with you, they are the same. So just read them. The formulas are there. So the other one that I will show to you is return on asset, which I already told you is the rate at which your business, your asset is putting itself into use. How is generating revenue also. Now, let's see an example. Return on asset can be calculated in 2 ways. One, either as net profit margin. You first of all, return on asset is net profit margin multiplied by asset turnover. Asset turnover is equals to total revenue divided by total asset. Just note the formula. Then return on asset can also be called as net income divided by total asset. Then let's see an example. Example 1, using income method. The following data is used for each example. 1, the net income of a project is $150,000. Average total asset is 800,000. While total revenue is $1.5 million. What is the return on assets? The return on assets using the income method, which is this one, is net income divided by total assets. If I divide the income, which is the revenue, divided by the total asset, I'm having this, which is 1.85. This is the return on asset. What it means here is that it's like 1.85. For every 1 naira you are spending, you are getting 85 in return. 85 kobo in return. Or in other words, if you do it 100%, it's going to give you 187.5, which means that for every 1 naira you are spending, you are getting 87 in return. So the other example is the other one. Hello. Hello.
The ROE.
Hello.
I think the percentage should be 18.75. 1.875.
Okay, when you divide, when you divide.
0.1875 times 100.
Okay.
Give us 18.75.
Okay. Sorry. Okay, should be an error in the calculation. So when you do these are simple calculations, you can easily check on your own, maybe during the typing error. Oh, okay. I really remember. I forget. I'm not using the PowerPoint. I'm not using the PowerPoint, the original. I'm using the PDF material. I've already edited it in the PowerPoint. So
it's like the $150,000 should be 1.5 million.
Hello.
I said the $150,000 should be 1.5 million.
This one. Is it this one? Is it this one you are talking about? Can we hear him? This is the net income. The net income is 150,000. This is what we have here. Okay, let's proceed. If we are using item example 2, which is using the net profit method, the following data is also used. Okay, somebody who's Zuma, you want to ask some question? I can see your hand. Or is it the former hand?
I'll bring it down. It's the former hand. I'll bring it down.
Okay, he's still paying attention here. So the other one is net profit margin, as we have said earlier, is net income divided by total revenue. This is the net income divided by total revenue. We are having the net profit margin. Asset turnover is equals to total revenue divided by average total cost, which is what we do here. We get this. So when you multiply return on asset, is equals to net profit margin times asset turnover. When you multiply this, you are still having this, which is what we also have here. So if you multiply it by 100, you are still getting the 18 point this, which is what we still also have here. So in either method, you can use either method to calculate your return on asset. But what really matters is what is it telling you about your project? Is the rate at which your business is generating assets, the rate at which your asset is being put into use. So there is also material we also share for you, but you have to learn how to do this calculation because there is likelihood that it will come out in exam when you are practicing, when you want to prepare for the CCP exam. Then when we finish that, I think these basic financial ratios, the attribute of a put asset, we are talking about this, the cost. For example, if you want to do purchase an asset, there are attributes you have to consider for that asset. One, the price of the asset, or the cost of the asset. Two, the feature of the asset, which make up the characteristic inherent of that product. And the other one is availability. You may see a product that is very good. You may see a product that is very cheap, but the product is not available. You will not get it as when due. So those three features should be considered when I try to acquire an asset: the price, the features, performance, and the availability. So under exam condition, you might be asked, in trying to purchase an asset, which of the following will not be given priority? Maybe price, performance, schedule. Maybe they give you another option because the exam is objective. You'll be able to know the one that is not applicable to you. So remember, I have already discussed the difference between price and cost with you. Why price is, remember that the seller provides a price while the buyers receive a cost. For example, if the buyer, when I buy a product, to me, for example, I went to the market, I want to go and buy a biro. If the biro is 20 naira, if I pay that 20 naira and I receive the pen, me, the buyer who received the pen, the money will be called cost because that is the cost of the pen to me. But to the person who sell it, is a price because that 20 naira I am paying the person is a combination of his cost plus his profit. So that is why the seller provides the price while the buyer receives a cost. So remember, return on investment is best used to compare projects within the same industry. For example, when I told you just now that on exam day, you may be asked in the manufacturing companies, you have 3 projects that you want, 3 assets you want to appraise. The return on asset of each of them is as follows. So which one will you prefer? The one with higher return on asset will be the one you will choose. And before you can compare them, the industry, the business must be within the same industry. You can't leave one industry, automobile, you go to a telecom to compare the same projects because they are in different industry. Now, the next one we now talk about is elements of cost which we have already discussed the three of them, which is material, which is labor, and which are expenses. So those are theory that you can read on your own. Questions are not really more frequent in this place. But the one, I will come back to this slide tomorrow. But for now, because I'm taking it step by step, now the one I will go further now so that they will align with what we have just teach is, let me see. I think that is another, let me check it. Okay. So can you see my new screen? I don't think I've shared the new screen. Can you see this screen?
Yeah, we're
Yeah, we
seeing it.
can.
Okay.
Yeah, we can.
Okay. Now at this point, I want to discuss this economic cost analysis with you. There is I flagged the material from another training program. There is a program we have been running. We normally do it. We normally do the program 10 weekends, once every week, every Saturday, 10 to 12, for those who don't really have the time. Every Saturday, 10 to 12. We are doing it for 10 Saturdays. We call it Cost Engineering and Business Lab. I think we started October 2nd. I think we will finish it December 11th. This is the first edition of this program. When we finish the second edition, we start around January. But let me flag the material from there to teach you this one. But it's also, you also have the same material. I will also share the same material with you. So now, at this point, let me, okay, is my audio okay now? My audio, is it okay now? Somebody is saying the audio is frustrating. Hello?
I hear you loud and clear.
Okay, fine. Now, let's go
I think
to...
it's getting better again.
Okay, fine. Let's go to economic cost analysis and investment appraisals. Economic cost, so that the whole training will just flow with what we just discussed today. Then tomorrow we enter another new dimension of it. Now, another thing we need to do is that we have what we call economic cost analysis and investment appraisal. As a cost professional, you should be able to appraise an investment. You should be able to really tell your company, this business you want to enter, is it okay or is not okay? You don't just jump up and enter into business. You must be able to evaluate that business. That economic analysis is look into the gain and loss of one course of action versus another. If you have multiple projects, you are deciding which one will you go. So you appraise them. When you appraise them, the one with the better appraiser is the one you will pick. In the course of these appraisals, we will talk about the time value of money, impact of tasks, talk about depreciation, then we'll talk about the various economic analysis. Now, we already discussed this type of cost with you. Another important things I will discuss with you first is what we call the consumer price index, which is used to measure inflation in an economy. Why economic analysis? Economic analysis is just basically because of the nature of inflation. Because inflation normally affects the value of money. That value of money is what we want to really see. That is the equivalence, the time value of money. The time value of money is what constitutes the concept of economic cost. And it is as a result of inflation. We have what we call an inflation and we have what we call an escalation. Who can tell me the difference between price inflation and price escalation? Who can tell me? Is there anyone? The difference between price escalation and price inflation. Is there anyone? Anyone?
Hello?
Okay, Adeniyi. Okay.
Hello?
Yes, I can hear you.
I can try for the inflation, but the escalation, that one I will just give my best guess.
Anything, there is nothing that is wrong. So anything.
Okay. Price inflation is a consistent increase in the price of commodities in the market. Why price escalation is that I think it's where the price has increased to a point where it's not bearable, then
Okay.
I don't know. So that's my best guess for that.
Okay, you have also tried. Any other person?
I think, hello?
Yes,
Can
we can
you
hear
hear me?
you. Yes.
I think price escalation is an imaginary or arbitrary, something that is more or less like a tick. It just increase. Whereas the price inflation is due to the economy of the nation.
Okay, you are trying to get there, but let me quickly just explain it in the. Okay.
Hello, sir.
Yes, I can hear you.
Yes, thank you. From my point of view, is like you're talking about inflation is a kind of where you have the forces of the market determined maybe by reason of your cost and the demand.
Okay.
But talking about the escalation, it's like just an arbitrary increase. Maybe people decide to just add money arbitrarily, not a function of the cost of production.
Okay, fine. That is also correct. So in a simple term, when inflation affects the general economy, which means inflation affects every sector of the economy. And that is why to measure your inflation, we have what we call the basket of inflation. What it means, that basket of inflation means, is that you have to put in about 1,000 goods inside that basket and check their price variance over time. From there, you'll be able to come up with a singular figure that you call the inflation rate. But escalation is also an increase in materials or in labor, but specific to a particular commodity. For example, we have a general rise in price of material, but let's say the price is affecting only cement. It's not affecting the economy generally, but it's affecting cement. Or it's affecting laborers, the bricklayers. The bricklayer has decided to increase their labor fee, but it's not affecting painter and other ones. So that is called price escalation. When it affects material, it is called material escalation. When it affects labor, it's called labor escalation. And why is it important is that when you are into planning, when you are planning or budgeting for your project, you have to put into account what we call escalation clause. Escalation clause means, okay, we are entering into this contract together. If I agree to perform the work for you at the rate of so amount of money, but during the course of the project, if inflation or escalation exceed so amount of changes, we will not be able to finish this project again. We will come back and review the price. That thing will be affected. That is what we call economic price adjustable. If in different types of contract, where we have fixed price contract, cost reimbursable contract, and fixed price economic price adjustable. So when the inflation or escalation changes, you will come back again and review the contract and adjust the price. So that is the difference between inflation and escalation. But to measure inflation, you use what we call the consumer price index. The consumer price index is cost of market-based basket in a given year divided by the cost of the market in the base year. So let me show what it means. Let me show what it means. Now, consumer price index is here, and we have, these are various items: maize, corn, bread, wheat, cloth. These are the various quantities. These are their prices in 2010. This is now their current price in 2018. So when you want to calculate their consumer price index, what you need to do is multiply this quantity by this price, 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 this quantity by this price. When you finish, sum all of them up, you will have the market basket in the base year 2010 as this. Do the same thing for where we are now, 2018. 100 times this, this times this, this times this, this times this. When you finish, sum all of them up, you will have this. By the time you divide this, by the time you divide the consumer price index is in the given year over the base year. When you now divide this one, when you now divide this one by this one and multiply by 100, you are having this. When you now get this, what does that one mean? It's telling you that the consumer price index is 132.5, meaning that the base case is 100%, but the current case is 132. When you minus 100 away from this 132.5, you are having 32.5. This 32.5 is now your inflation rate in the economy. That is how inflation is being calculated. Now, the drivers of change in
Hello, sir.
Okay.
Hello, sir.
Yeah, I can hear you.
Yeah. Is it okay to ask a question?
Yes, go ahead. Go ahead. Yes.
Okay. I believe the reason for this part is to help us plan better.
Yes.
While we are conducting our project
planning.
Yes.
Yes.
So if I'm putting together my project costs, and I think it's a good idea for me to also impute my inflation rate if the project is going to last me for a period of 5 years.
Yes.
Because I know whatever I have on my BUQ, BOM today will not be at the same cost at the 5th year of completion of my project. So at that point now, using this same method, how can I impute this inflation rate that I will not have to go back to my stakeholders that, okay, based on this, inflation have changed, inflation have risen, and the agreed costs for this project is going to increase. So, and also I'm aware that on the contract agreements, there's also a portion there that states that, okay, should inflation increase going to happen based on the so I'm just trying to see how in this area, just to make sure that we don't have to go back to the stakeholders.
Okay.
Hello?
That is very fine. It's a very good question. So I decided to mute everyone. So I will explain to you. It's a very good question, and that is supposed to be our next topic. Now, what it means when you get this your inflation and you want to enter into a contract, this inflation rate helps you to determine your pricing rate. What it means is that because if I want to give you a contract, you must go and borrow money from the bank to do that contract. If you borrow money and the inflation rate is this, it means that you that is borrowing the money, you'll be the one that will suffer. So what you will need to do now is that you will now see that if you borrow money now, today, and you want to use this for this project, that is what we now consider the time value of money. We now say, okay, this money I am borrowing now, what is supposed to be the value of this money with the rate, with the inflation rate in the economy in 3 years' time? Assuming this is the rate of inflation for the next 3 years, and you borrow money now, what would be the value of that money in next three years? So you will use that one to discount the money. So that one we will come to it shortly. Now we'll be doing exercise. You will now use that one to set your profit margin for the business you want to do, to give them your selling price. That if they pay me this money, and you calculate your internal rate of return. If your internal rate of return, which is the rate at which your business is generating revenue, is lower than this inflation rate, it means that you are running into problem. But if your internal rate of return is higher than this your inflation rate, it means that yes, despite we are in inflation rate, the money, your business is generating higher value that can counteract this inflation, and you will also have more money with you. But where you need to take a proper caution during planning is to not tell your client after doing your appraisal here based on this inflation rate. You will not tell them, I have accepted the contract now from you based on this current inflation rate, but we have to put what we call escalation clause and inflation clause. What does that one mean is that I need to do this project within a period of 3 years for you. And this is the agreed price based on the prevailing inflation rate. But if in the course of these 3 years, the inflation exceeds this 3.25, or the inflation is now 40%, we will not be able to continue with this project. We will come back and review it with you, so that you people should increase the cost of the price. But if there is no clause like that, they can't do anything for you. We have a similar case in my former company. What happened is that as a real estate company, we advertise for subscribers to come and buy houses from us and everything. And some of the subscribers, they pay outrightly their full money, some are paid instrumentally, and we agreed. But there was no inflation clause, there was no escalation clause. That was around 2015 or so. And the project started. Within a period of 1 year, as from 2016 or so, inflation hit the economy. And we could not go back again to tell them that we have exceeded the inflation rate based on our initial planning purposes, increase our money. We could not meet them. So we are strongly, the houses we are supposed to deliver to those clients within a period of 3 years, even after 5 years, we could not deliver a single building to them. What happened is that some of the subscribers even took us to court, took my company then to court, that by now they are supposed to be landlords. They are still paying house rent wherever they are, that our company should be paying their house rent until we finish their building for them. Why? Because there was no inflation clause and escalation clause put in place. I hope it's clear. I hope you understand it. It's clear.
Yes, it's clear. Thanks.
Okay, fine. Thank you very much. So just give me a second. I'm trying to respond to this NSC people. They are calling me. Now, okay, we are done with that. The other one is drivers of what are really the causes of this change. We already talked about inflation. We talk about deflation, the opposite of inflation. We talk about escalation. So you can read all these ones. So the ones I will not talk about quickly now is depreciation. Remember, let's try to mute ourselves. Now, remember we talked about asset just now. Why we talk about the return on asset, return on investment, and we also talk about what we call depreciation of an asset. Because asset doesn't last forever, If I purchase a computer today and tomorrow I want to sell it to somebody, the person will say, the computer has already reached your house. I will not buy it the same amount of money you have spent for it, because it has undergone tears and wear and the value has dropped. So at that point, you will not know how to calculate your depreciation amount. That will help you to know when you are going to recoup back the money you have put into that business. That is why you see that the bank, when they give you loan, they will be recouping the loan from you through amortization, and they will be depreciating the value of your asset for you and getting their money back. So what are the different methods that they use to depreciate their value? And under what condition do they use each of those methods? So depreciation, as we already know, is the physical loss in value over time of any asset you have due to old age, due to deterioration, and due to time. Depletion, we also have what we call depletion. Depletion is similar to depreciation. While depreciation is for physical assets, depletion is for like natural resources. Because you can't say oil well has depreciated. No, oil well deplete. Quarry, they deplete. Plantation, they deplete. So let me pick this call.
We can't hear you anymore.
Yeah, I guess it's the network. Let me call him.
Hello, sorry. I think today is our NSC meeting, Nigeria Society of Engineers. So I'm supposed to I'm the General Secretary. So they quickly require some information. I just passed the information to them. Okay. Please, can someone explain escalation rate again? Who can help me explain escalation rate to Adeyemi? Who? Let me see whether we are following. Adeyemi, do you still need the explanation?
Yes, I do, sir. Just the escalation rates. I understood the inflation rates, but I missed out the escalation part, sir.
Okay, I think Kisley want to help us to explain to you. So Kisley, help us to explain to him what is escalation.
It's okay. Based on the impact we have received from our lecturer today, he talked about escalation. Escalation has to do with specific. For instance, there's increase in cost of labor. There is increase. Let's use labor. Maybe your mason, maybe your carpenter, or maybe your painter. The price has increased from 4,000 naira per day to 5,000 naira per day. That cannot be seen as inflation because is a specific. Okay. It's not a major over period. It's just a specific on a particular item. So that is called price escalation, not inflation.
Okay, correct. Perfectly explained. Okay, any other persons? I can see somebody's hand again.
Thank you very much.
Okay, you okay. You are okay now. Okay, fine. Now,
hello.
Okay, hello. Somebody...
No, just to throw more light. Just
okay.
to throw more light on it.
Okay, go ahead.
From what I deduce from you is like a change in price of a particular commodity or services, which is associated to maybe a particular job or a particular asset.
Exactly.
That's what I see as escalation rate.
Yes, that is it. Okay, thank you very much. Okay, now let's quickly discuss the three methods of depreciating an asset. Then we'll take another 5 minutes break and come back. There are three different techniques for depreciating an asset. One is the straight line method. This one is not, please correct it. It's a straight line method, not single. Straight line method. The other one is double declining balance method. The other one is sum of year digit method. So now I will not just be do the calculation here, but I will just do the calculation for you in Excel to see how it works. Let me see our Excel sheet. Okay, can you see my Excel sheet?
Yeah, we can.
Really? Can you
Yes,
see it
we
now?
Yes, yes.
Okay, fine. Now, as I said earlier just now, there are three methods of depreciating an asset. One is the straight line method, two is the double decline balance method, and third is the sum of year digit method. Now, if you want to calculate depreciation based on the straight line method, this is the asset before us. An asset original cost price is 5,000 naira. And the asset is to last for a period of 5 years. And at the end of the 5 years, when they sell the asset, is going to give them 1,000 naira. That 1,000 naira is what we call the salvage value, the value of the asset after its useful life. Now, if you want to calculate the depreciating expenses over this period, is for you, this is the straight line method now, is the cost price minus the salvage value. That is the depreciating expenses for the 5 years. But if you want to calculate the annual depreciation, you will now divide the depreciating expenses by the numbers of years. What it means is that the asset is losing value at the rate of $800 every year. The concept behind this depreciation is that let the depreciation be uniform throughout the depreciating period. For that 5 years period, let it be uniform. But some organizations, especially the bank, they don't use this because a bank presumes that when asset is the earlier you recoup your money back, the better for you. If you are doing it equally every year, it means that the money is not coming early. And based on the time value of money, you will not be able to get the actual value for your money. Now they now come up with what we call double decline method. But if you want to do it in Excel, this is straight line method. You have the year 1, year 2, year 3, year 4, year 5. You will get, let me delete it. What you will do, just come here to the first year here and go to formula. Can you see my, go to formula. When you go to formula, go to financial. When you go to financial, look for SLN. You can see it here. This is straight line method. Just click it. When you click it, a box like this will appear for you. The first one is cost. What is the cost? Click the cost. The second one is the salvage value. Click the salvage value. The other one is the life. The life is 5 years. When you click OK.
No. You picked the wrong salvage value.
Okay. Okay, thank you. And I'm already seeing the wrong answer. I will have to go back. Okay, the first one is the cost. The second salvage value is 1,000. The life is 5 years. I will click it like this. You can see is this. But because it's constant for all of them, I would have as well constant everything here. I will just constant here by putting a dollar sign in between. Come here, put a dollar sign in between. Come here, put a dollar sign in between. I will constant it. So if I drag to the end, everything will just be 8,800, 8,800, 8,800. You can see that when you add all 800 together, you are still having the 4,000 naira, which is your depreciating amount today.
Yeah, excuse me. I wanted to ask a question, Doc.
Okay.
How do you beforehand calculate the salvage value of an asset? How would you calculate the salvage value of this asset from inception?
The salvage value is based on company policy, based on the market price. That, for example, if you want to buy HP fairly used computer, you already know from market survey, you get the information from the market that a second-hand HP computer is cost 200,000 naira. So you will use that information to set your baseline, to set your baseline. So that is how you can get your salvage value at that point. So
hello, sir.
Hello.
Sorry to say that particular information will be as at today, not as at in 5 years' time.
The salvage value.
Yes.
The salvage value of that asset is when you dispatch the asset in 5 years' time, what will be the cost? Is the future sum, it is the future value of the present worth of that asset.
Yes, because he asked a question that I think is a concern to me.
Yes.
He asked, how do you get this salvage value? Because we're looking at 5 years from today.
Yes. So I understand that this is how you get it. This is how you get it. For example, now, as we speak now, the value of a fairly used computer, let's say, is 20,000 naira.
Yes.
But your asset is based on a 5 years period. How will you know the value it will be in 5 years' time? So you already know the present value now, which is 20,000 naira. And you will check the inflation rate in the economy. Let's say the inflation rate in the economy is 5%. So based on this inflation rate, you know the present value, you will calculate the future value. So that future value will not be your value, your salvage value in 5 years' time. So we are coming very soon when we'll be talking about present value, future value, net present value. Yes. That is how you get it. Okay. Now, when you get that, this is how you get it. You will depreciate it. The depreciating amount for that period is 2020, 2020. The double decline balance method assume why it is called double is the depreciating rate is 2 times that of straight line method. If the depreciating rate for the straight line method is 20%, double decline method will apply 20%. It will apply 40%, double the depreciating rate of the straight line method. Now, let's see how it works. Let's see how it works. I will also show you the manual. Now, this is the Excel sheet. What you do, you come here, go to your financial, look for double decline balance method. Look at it here. Double decline balance method. Click it. When you click it, the first one is what? Cost. You put the cost. The second one is the salvage. Put the 1,000. The third one is the life. Put the 5. The other one is the period. Why life? Why life is the general period of the investment, which is 5 years. The period is individual year. The period will be the first one, the second one, the third one, the fourth one. So I am starting for the first period. I will click first period. Because the cost is going to be constant, is going to be fixed, I will constant it. Because the salvage value is going to be constant, I will fix it. Because the life is going to be constant, I will fix it. But the period is not going to be constant because if I'm dragging down, it should be referencing 2, 3, 4, 5. So when I finish, I will click OK. When I click OK, I can just drag down. I'm having it. So what this one make is that the first year, they will remove 2,000. The second year, they will remove 1,2. The third year, they will remove 720. The fourth year, they will remove 80. By the fifth year, everything has been depreciated. What is the concept behind this? That the earlier you get your money back, the earlier, the better. If after 2 years, look at this, if after 2 years, the vendor run away, the bank will not lose anything much. Because they have already quickly recouped back their money for the first 2 years. That is how double decline balance method works. Now, for the one of sum of year digit methods, the sum of year digit method principle assume that the sum of year digit method assume that the earlier, if you buy an equipment today, if the equipment is new, the capacity of production will be high than when the asset is getting old. So as far as the asset is new, let me quickly get my money back when the asset is new. That the more newer an asset is, the more the payback period, the return period of the asset should also be. So in that case, what you will do, I will come here, I will delete all of them here. I will come here, I will look for sum of year digits. Go to formula, go to financial, and look for sum of year digits. This. Is it this? No, this one. The first one there is what? The cost. You click 5,000. The second one is the salvage, you click 1,000. The other one is the life, you click 5. The other one is the period, you click this one. Then you fix the other one by putting a dollar sign. I'll leave the last one. You click OK. So when you come here, just drag down, you're having it. So this one means since the asset is new, you can see in each of this method, the depreciating expenses is the same throughout. 4,000, 4,000, 4,000. So this is how an asset value is being depreciated. Let me show you how.
Excuse me, sir.
Okay.
Hello, Doc. What can we use as a yardstick to make this decision? Either to use SLM, DDM, or SOYD.
Is your financial institution that is financing your business is the one that will tell you what they are going to use to depreciate your asset. Majorly, this is what organizations use, this double decline balance method. So this depreciation means if they give you this, you should be very happy because what they have considered you, they have spread the risk for you equally throughout the period. If this is better for you because you are paid a little bit throughout. But this one means that no, we don't want to risk this money we have given to you people. It's better we get it back. So this is what most of the bank, this is what they use in depreciating our asset they finance. So
sorry, sir. I just want you made a statement now. Yes. Depreciation is a non-cash item.
Yes.
So it is not the money I'm paying to the bank for financing an asset.
Yes.
This is just a way of recouping the investment in my books.
Okay.
It's just an accounting record.
Yes. Do you know why?
And for tax purposes.
Do you know why it is like that? For example, when bank want to finance your investment, or assuming you want to buy a plant, and a bank want to finance it for you, bank will tell you to go and bring your depreciation accounting system. That your depreciating accounting system, what it means, what you know why bank has interest in this is that what if you can no longer pay, what they will do is to go and value that asset. They will call valuers to go and value that asset. When they value that asset, they will get their money back. But when valuers want to value the asset, is the depreciation system. They will know the value of the asset after the first year. Assuming you want to value the asset after the first year, is to just to come and remove 2,000 naira. And remove 2,000 naira. The remaining one is not the value of the asset. So that is why they link it up with financial institution in case you want to carry out your valuation system, or the bank want to, or the owner even want to sell it, or the owner want to sell it. The owner will know what to do. So
yeah. Okay. So I understand what you just explained now, yeah. But valuation has two angles to it. There is when the bank is valuing an asset for foreclosure, it takes into consideration the open market value and the for sale value, which has something to do with the book value. So the book value is what the company, what I have put in my ledger as the book value. And it doesn't matter what the valuation report turns out to be. Valuation reports will just do the valuation as regards to the physical state and the economic value that anybody can still gain from that asset. So that's now what is going to form the value of the asset.
I understand you. What that one means is that, in valuation, there are three methods of doing valuation. They have the precedence method. They have the market rate, which is the market valuation system, and they have which other one? I think they are three. Now, when you are using the market valuation system, that is when you come in, you carry the asset, you go and give it to the market. What is the current price of this asset? This current price of this asset is what you will use it to value it. Now, when the bank, for example, any or government, they want to sell, maybe they want to value your property either for winding or for emergency cases. What they will first of all know is that they will know the value of that, the book value of that your equipment. Do you know why? What if they want to sell it at emergency, as an auction says? They will not consider the market price. This is the book value they will consider. Whether they are going to sell it as auction rate or not, they will never sell it below the book value, but they can sell it below the market value, but they can never sell it below the book value. That is why that book value is still very important when you are doing that valuation system, especially when you are doing precedent evaluation system, not market value systems. So that is how they interrelate with each other. But most organizations use this double decline method with the concept in their mind that the earlier they get their money back, the better for them.
Okay, sir. Okay. Prof, good evening. Let me just throw small light on it.
Okay.
Yeah, you said it all. When you even started the introduction, you said something. These things are always based on company's policy.
Exactly.
And that is the whole key thing, because if you are using the double method, if a company employs you and they are giving you a car in which you are going to be paying till you pay off the loan,
yes,
they first of all now look how many years are you going to put for service for them.
Exactly.
So the years you want to put for service, they are going to suffer you before that time. They also know. And if they are going to be taking it away from your payoff, they also know. So let's relate it to our own organization, which is the project management organization. Or because if we are using the bank, so some people are thinking, money is like, let's use material things like oil wells, all these cars and all these things for it. It will help us. I don't know if we get us.
Thank you very much. Yes, you are very correct. Okay, so at this point, let me quickly show you the manual aspect of it. Are you seeing this? Are you seeing this thing?
Mm-hmm.
Okay. Assuming you want to calculate it manually, maybe in exam, because you will not be using Excel on exam day. When you are using double decline balance method, you already know that the initial cost is 5,000, the salvage value is 1,000, while the period is 5. So what you need to do is that is why it is called double. The numerator will always be 2. That is the formula. The numerator will always be 2. The numerator will always be 2. So what you will do is 2 over the period, the life, which is the life now, which is this 5 years. We always just be there, 2 over 5, 2 over 5, 2 over 5, 2 over 5, 2 over 5. All of this is the formula. So you see this slide. So what you will now do, when you are calculating for the first year, you will take 2 over the useful life. Since the useful life is 5, that is why we have 5. But the 2 will always be constant because it's the double. Now, when you now take 2 over 5 bracket plus the current value of the asset for the first year, which is the cost of the asset, 2 over 5 or 5,000 will give you 2,000. 2,000 is what is depreciated for the first year. So when you subtract that 2,000 away from the original cost, which is 5,000, you now have 3,000 as the book value at the end of the first year. So when you are coming for the second year, that book value is what you will now bring in. 2 over 5 of 3,000, you get to 1,2. So this 1,2 away from 3,000, you now have 1,8. So that 1,8 is what we will bring that again for the third year. So that is how you will be doing it. But look at what happened here. When you get to this place here, when you get this one as 108, you get this one as 108. And you want to do it for the fourth year. For the fourth year, you bring the 108 again, and the value is 430, and the value is 432. This 432, you cannot take it to this side again. Do you know why? Because we were told that your salvage value is 1,000, meaning that your asset cannot be depreciated more than your salvage value. Your asset cannot be depreciated more than salvage value. So when you are already here on the third year, the book value is 1,080. So since the book value is 1,000, what you just need to do is to subtract that book value amount from this balance you have. The remaining 80 will not be the depreciation amount for the last year, because asset cannot be depreciated more than its useful value. Do you understand here now? Should I repeat? Is it clear?
Trying to catch up.
Okay, this is what we do. On the third year, we now have this 1,080. This is the balance of your asset on the third year. But we were told that the salvage value of the asset is 1,000, meaning that the asset cannot be depreciated more than 1,000. That is the last money you will sell it at the end of it. So if you now bring this value to this place, the way we are doing it, we have 432. If you subtract this 432 away from this one, the way we have been doing it, the value will be less than 1,000.
Yes.
And our asset cannot, we said the salvage value is 1,000. We can't go below that. So what you will do when you are not here and the value is not close to 1,000, subtract this 1,000 away from this. That balance 80 will not be the depreciation you will remove on the fourth year. So what it means that on the fourth year, this asset has already depreciated its value. This is how we use a double decline method. Then in the sum of year digit method, how we calculate the sum of year digit method is, first of all, sum up the whole digit. That is why it is called sum of year digit method. 1 plus 2 plus 3 plus 4 plus 5 will give you what? 15. Then when it gives you 15, when you are starting from the first one, start from the value of the highest period. When you are starting from here, start the period from here. This formula, when you look at this formula here, you can see the 5 is even there. So what you will do, when I'm in the first year, The numerator will be the same throughout, which is 50, 50, 50, 50, the denominator. But the numerator will now be changing in inverse. The first year is 5 over 15. The second year, 4 over 15. Third year, 3 over 15. Fourth year, 2 over 15. Till you get to the last one, which is 1 over 15. You will be using, this is what is just changing. The cost will remain constant throughout. 5,000, 5,000, 5,000, 5,000, 5,000. It's only these ones that change. 5 over 15, 4 over 15, 3 over 15, 2 over 15. This is how you get the depreciating amount for each of these years in sum of year digit method. So at this point, I will give room for 5 minutes. I'll give room for 5 minutes. We come back by, this is 5:33. We come back, let me just say 6 minutes now. We come back by 5:40. When we come back by 5:40, we will see if we can quickly use the remaining 25 minutes or 20 minutes to carry out the net present value, the future value, the internal rate of return. Thank you very much. See you in the next 6 minutes. Let's see. What we want to discuss now is we want to discuss this economic investment appraisals, how you can using it, how to calculate the future present value of money given the present value, given the future value, how to calculate the future value given the present value, how to calculate the net present value, and how to calculate internal rate of return. So, and we will use Excel as a financial tool to do it today for the remaining minutes we have. Tomorrow, we will do the manual before we enter the module for tomorrow. Now, assuming you want to borrow money from the bank, and the bank wants to be putting interest on that money, and the inflation rate in the economy, what I want to do now is that, for example, your dad said he wants to be putting 10,000 naira in the bank. You want to put 10,000 naira in the bank for you now for a period of 3 years. At the end of the 3 years, bank said they are going to give you a certain amount of money. And your father don't know how much the bank will give them. So your father will only tell you, I have put in 10,000 naira in the bank for you for a period of 3 years at the rate of 10%. But in 3 years' time, go to the bank, they are going to give you a certain amount of money. But what you don't know how much the bank will give to you at the end of the 3 years. But you only know that your dad is deposited 30,000 naira, has deposited 10,000 naira in the bank for you for a period of 3 years at the rate of 10%. You'll be a financial cost engineer. You will now want to know, let me know how much will the money be in 3 years' time. That is the future value of money given the present value. So what you will do, still go back to our financial here, go to our formula, go to financial and click FV. Where is our FV? This is our FV. You click FV. When you click FV, what is the rate? 10%. How many years? 3. How much is it put in the bank now? 10,000. This PMT at the center, leave it now. We'll be using that one later or tomorrow. Then at the end of the day, you click OK. What it means is that in 3 years' time, at the end of 3 years' time, the bank is going to give you $13,310. This present value is showing a sign of negative. What is it telling you? Who can tell me?
It's an outflow.
Correct. Very correct. So in financial analysis, anytime you see negative sign like that, or you see a value in bracket, you will know that it is a negative value. It doesn't mean that the value is negative. What it means is that it's a cash outflow, the one leaving your pocket. But the one coming in is inflow. That one is positive. Okay, fine. That is good. Now, another one I will tell you is that we use this formula just now to calculate the future value based on the 3 years we have and this. But when we know for dynamic interest rates, we can say the interest rate is constant, 30% for the first year, second year, and third year. But when you have dynamic interest rates, that means interests that are changing with time. The first year interest is different, the second year's interest is different, the third year interest is different. So what you need to do, you instead of using this normal FV, you will use what we call F schedule. For example, if for the first year the interest rate is 4%, the second year is 6%, the third year is 5%. So what will be the future sum of that money? So what you just need to do, instead of using this FV, because the interests are changing, you will now use what we call F schedule. In that case, you will come here, go to financial, look for F schedule. This is F schedule. So what you need to do, the first one is the principal. The principal is the 10,000 naira. The schedule is this 4, 6, 5. You click the first one, hold down your mouse and drag to the third one. When you click OK, you are seeing the value here. Now, let me compare why they do it in such a way so that you will not be confused with it. Let me use this one. This is the same thing we have just now. 10% and first year, second year, third year, the interests are constant. But instead of using FV with this, I can also form a table like this, put their interest rate, though they are constant, but I will not use FV at this time. I will use F schedule. If I go back to my formula, recently used F schedule, I will click this one. The schedule will be this one, drag down to this. You can see that this answer and this answer, they are the same, despite I use different FV and the other one F schedule. So this is used for dynamic interest rate. This is used for constant interest rate. Now, the other one I will show to you again now is the net present value. The net present value means you are given the future value for a certain period at a certain percentage. How much will be your present worth now? This is what we have here. Assuming your father told you that I am going to, let me see if I'm recording you, I hope so, okay. Your father told you that I am going to I put some money in the bank for you. But the bank said in 3 years' time, they will give me back 10,000 at the rate of 10%. But you don't know how much your dad is putting in the bank now. So you will not tell your dad, no, let me check how much you are putting in the bank now. So you cannot come here, calculate the present value with the future value node. You will not come here, go to financial, look for present value, PV. Then the first one is the rate, 10%. Numbers of year is 3. The future value is 10,000. Then you click OK. You can see you are putting, your father is putting $7,513 now. You can see the value is in bracket with red. That shows that it is an outflow. An outflow means that is the money that is leaving your father's pocket. That is how you can calculate your present value when you know your future value. But the concept of present value and net present value does not take into account the time value of money. What these two methods suggest is that the value of money today is going to be the same value of money in 3 years' time, whereby in this situation, it's not supposed to be so. In that case, instead of using this PV or LV, normally you will now use what we call net present value. If you are evaluating the business using present value and net present value, the value given by net present value is the best. When your present value or your net present value is positive, it means the business is good, go ahead. When it is negative, it means the business is bad, don't go ahead. When it is zero, it means the business is at break even. You use your discretion to go ahead or to remain. But this one showing negative here inside the bracket does not mean it is negative value. What it means is that it's a cash outflow. When it is a negative value, this one will become plus. Now, the next thing you will need to do now is the concept of net present value. The net present value takes into account the time value of money. That is why it is better to use net present value in appraising your investment compared to present value, because that one takes into account the time value of money. Okay, now let's see what happened here. A man wants to invest 10,000 naira to buy an equipment. The projected cash flow expected for the business is that for the first year, the business will be able to get $3,000 back. The second year, $4,000. The third year, $4,000. The fourth year, $3,000. At inflation rate of 5%. The inflation rate in the economy is 5%. That is the rate at which money will be losing value. Since that is the rate at which money will be losing value, you will be discounting the money. If you earn 3,000 naira today, the first year, reduce the value by 5%. If you get it in 2 years' time, 4%, 4,000, reduce the value by 5%, so that you will begin to get the present value of those future money you are projecting. So in this situation, this investment, if you want to check it, what I will first of all say, I invested 10,000 naira. The first year, I get 3,000. The second year, 4,000. The fifth year, third year, 4,000, and the fourth year, 3,000. If I sum it together, if I sum this one together, I'm having 40,000. If I compare this 40,000 to this 10,000, what will just come to my mind is that I will make a profit of 4,000 at the end of the fourth year. But without considering the inflation rate at which the money will be losing value. So to get the actual value is, you come here, net present value. You will click financial, look for NPV, this NPV. The first one there is the rate, which is this 5%. The other one is the value. The value you do is that this is the value. The inflow, you know, the first one, negative 10,000, that is the outflow. The outflow is not included. You start from the inflow. You bring the inflow down. You click OK. What it's telling you is that based on the discounting rate at which money is losing its value, this is the actual value in 4 years' time, unlike this 40,000. This is the gross NPV. So for you to not get your net NPV, you will now minus this one away from the initial capital. You're not getting 2,408. This 2,408 is now your actual NPV. So when NPV is greater than 0, or when it is positive, it is a good investment, go ahead. When it is negative, it is a bad investment, don't go ahead. When it is 0, it is break-even point, you use your discretion. Now, but another thing I will show you is, what of when the cash flow is dynamic. This money, we are saying that the cash flow are coming 3,000, 4,000, 4,000, 3,000. We don't know when they are coming in. But what of when we know when they are coming in? The first one, the investment was carried out on December 4, 2011. The first money will come January 1st. The second money will come February 1st the other year. The third year, March 1st. The fourth year, April 1st. What will be the net present value for a dynamic process like this when you know when the money will be coming back? The same information we use in this previous one is the same information we still want to use in this one. So what I will do, I will come here, I will click here, I will go to financial. I will now look for OX NPV, not normal NPV. OX NPV. OX. This is the OX NPV. So the rate, the first one is the rate, 5%. The second one is the value. At this time, include everything because the investment also has a date. So start from here and go to the last one. The third box is the date. Start from the first date and come to the last. When you do it, you click OK. Now let's see something. We use this. Both of them, the same figure. This figure is equal to this figure. While we have $2,408 here, we have $2,899. The value here is higher than this value, despite they have the same figure. What could be responsible? Who can tell me what could be? Who can be responsible?
It's okay now.
Who can be responsible? This one. They have the same figure, but the value difference. This value is higher than this value. So what could be responsible?
Maybe interest was compounded on the second one.
No, they are the same.
I mean, compounded.
And the way the interest compound here, that is the way the interest also compound here. So what could have caused make that changes?
I think for the XNPV,
yes.
If you look at it properly, it's calculating 13 months.
Okay.
You know, December 1 to January 1 is actually 13 months.
Okay.
Compared to the NPV, which I think will just assume 12 months.
Okay. Now,
so
if you...
I think that one extra month is what brought about the increase.
Okay, that may not likely. What happened here is that you can see that the money are coming earlier during the period, January, February, March. The earlier you, for example, if you borrow somebody money, if somebody borrow money from you, two people borrow money from you, one pay you in December and one pay you in January of the same year, which one will you value most? So definitely
January.
The one that pay you in January is the one you will value most. That means that the earlier you recoup your money from investment, the more valuable that investment will be. Let's say, let me change this February. Let me change this February to February 28th. Let's see how it will affect this amount. Let me change it to February 28th. February 28th. What happened? The value dropped. Let me change this one to April 30. The value dropped again. So the earlier you recoup your money, the better the value for that money. So that is the difference between OX NPV and NPV. And you also know that the difference between NPV and normal PV is that NPV takes into account the time value of money, unlike the other. So the last one we'll quickly talk now before we close for today is the internal rate of return. The internal rate of return is the rate at which your money is generating revenue. I discussed one thing with you just now, internal rate of return and return on investment. We discussed it today. Is there anyone who can tell me the difference? Internal rate of return and return on investment. We discussed it today. Is there anyone who can still remember?
Return on investment takes through the project cycle, while internal rate of return is annualized.
Yes, that is correct. Very perfect. Now, if you have a project under exam, this question can be given to you. You are about to appraise 5 projects, and the internal rate of return for each of the projects is this. Which of the projects will you choose? Okay, answer this question here.
C. Project C.
Project C, you will be choosing because Project C has the highest internal rate of return. The higher the internal rate of return, the better the investment. And the internal rate of return is the rate at which your business is generating revenue. Where do we use it? We use it to benchmark an alternative business to see which one is better option. Let's take a case. Now, the same investment we used just now in NPV, we still brought it down. But why the company we are discussing this, the manager said somebody from the bank approached them yesterday that instead of putting this 10,000 naira in this business that will be generating all this cash inflow for them, why can't they just put the money in the bank at the rate of 10% interest? So the question is, they want to appraise this investment to see the rate at which this investment is generating money, and then compare that value with the 10% which the bank promised. The one that is higher will be the one that will be chosen. In such a case, I will come here, I will go to my financial, I will look for IRR. I will click IRR. When I click IRR, the first value there is the value. Just start from the first one, drag it to the last. The inflow and the outflow combined. Then the guess is the 10% I want to compare the result with. I will click OK. You will see that the internal rate of return is 15%. This is the rate at which the money will be, the business will be generating revenue. But this is the rate the bank said they will pay you when you put the money in the bank. So when you compare the two businesses together, you discover that this one has a higher internal rate of return. So it is better you embark on this investment rather than putting the money in the bank to repay you at the rate of 10%. In a short form also, we discussed NPV just now, that when NPV is positive, the business is a good one. When NPV is negative, the business is a bad one. A point will also come when NPV will be 0. The interest rate at which NPV equals to 0 is what we call this internal rate of return. The interest rate at which the value of NPV is equals to 0 is what we call this internal rate of return. Another thing I will quickly show to you is what we call the modified internal rate of return, whereby you have invested in your business, you are telling them the money that they are supposed to be paying you, you are not collecting the money. You are now rejecting the money back into the system, which is like a form of a SICI fund, interest-bearing interest. The money is being given to you are paid, you are not taking the money, re-inject it back. In that case, the bank can tell you, okay, we borrowed this money from you. We are supposed to be paying you this money. You are saying you are not collecting the money, we should inject it back into the business. For injecting the money back into the business, the interest rate we are giving to you will not be as high as the original interest rate, because we are now helping you to do all the risk. So in that case, the first rate at which the money was given out is the finance rate. When the money is now being re-injected back, the investment rate will not be lower, which is like 10%. Based on that, at what rate is this business generating money? When the first one produce interest, you put the money back again to reinvest. So in such a case, together, you need to consider what is now the aggregate internal rate of return. You have a question? Jibri, you want to ask a question? You can unmute yourself. Unmute yourself. Is it, I can see you. Do you want to talk, Jibri? Okay, but you can unmute yourself. Let me see if I can ask you to unmute yourself.
Jibri, can you click on the microphone icon there?
I have asked you to unmute. Unmute. Okay.
Okay, fine.
Yeah. Ask your question.
No, I don't have any question. I can go ahead.
Oh,
go
okay.
ahead.
Okay, thank you. So let's quickly just finish this and close for today. So in that case, you are not using ordinary internal rate of return. You will not be using what we call modified internal rate of return, which is MIRR. Let me do the example. I will come here, I will delete it. I will go to financial. I will look for MIRR. This MIRR here. Then the first value, the value there is what? This value. All of them combined from here to here. The finance rate is what? 12%. The reinvestment rate is what? 10%. When I click it, this is now the aggregate internal rate of return. Combine both the one you originally invested and the one you injected back together, the rate at which is generating revenue is now 30%. So the last for this session is we also have the way we have for dynamic NPV, we also have for dynamic IRR, where you know the date at which the money is coming back. So what you will do in that case, you calculate the internal rate of return. You are no longer using normal IRR, neither MIRR. You are now using OPS IRR.
Hello, engineer.
Yes, I can hear you.
Yeah, comment there.
Okay.
I just wanted to ask a question here before you go to that last table. Okay. If you go there, the question feels cut off from my head.
Okay, no problem.
Yes. So regarding this modified IRR, okay, I want to believe this return from first year, second year, and third year based on feasibility studies carried out on. I'm relating this to a project. Okay, so yes. I want to So I want to believe like this is a return from a feasibility study carried out for projection.
Yes,
for projections.
Yes.
So at this point now, if at the end of that first year, I'm not up to this, and I have done my on internal rate of return on these numbers here, yes. And at the end of the day, it's not giving me this, yes. Or it shoots higher than what I have here.
Yes.
Will I not be at any point either way shooting myself on my foot for either of the 4 years?
Yes. When the money you are going to generate higher than this value, better for you. Better for you because it's going to increase the internal rate of return.
Yes.
But when the projection fails, it's going to cause the problem to the company. That is why when you are projecting your investment, you factor in a lot of risk into it so that you will be able to meet up with that projection or slightly close to it. Because when you do a rough forecast, a rough projection, and the value you are not getting are not lower than this, you have caused yourself problem. So you are running into loss. Your internal rate of return will be lower than this value here, and it's going to cause you a problem. So we have answered the question. Okay. Now, the last one is just the safety of what we have done. Just come here, go to financial, look for OPS IRR. look for us arrow. Then the first value is everything combined. The last one is the date. Start from here, do like this. The guess is the 10% you want to compare with. You click. So your internal rate of return is now 24. So when you compare this 24 internal rate of return with this one, you can see that this one is higher because the money is still coming earlier, as in the case of the other one. So if I increase this one now to about 30, the money is coming on the 30th of March, this value will drop. So that is how we can use PV, net NPV, internal rate of return to evaluate investment. So tomorrow, when we come in tomorrow, we will show you how you can also use some of manually using what we call the interest table. Let me see if I have the interest table here already. Okay. Now we have the interest table here coming. So you will see there on the interest table. Can you see the interest table? Can you see my screen, the interest table on the screen?
Found interest table.
Yes. Okay. So this is what we'll be using tomorrow. If you want to do some of those calculations manually, maybe on exam day, you have to do some of them manually. So at this point, we give room for just a few questions and answer, and we'll call it a day. So tomorrow we'll continue from here again. So do we have any question at this point? And another, okay, we have Ahmed Shaibu. Okay, ask your question.
Good evening, Mr. Doc.
Yes.
Though I joined lately, I didn't join on time because of an engagement I was in. My question is this: for the CCP exams, how do we pay to the examination body?
Everything is online.
Okay.
Everything is online, and if you also want us to help you pay, do the registration follow-up, we also assist you, no problem.
Okay, thank you, sir.
Yeah, and most importantly, also, I think we have some people here on the training that they have not registered for this training, because we just send the link and most of them join like that, and we know them. We have seen people, so we just feel okay, just enjoy today. But just try and make your payment after the training today, so that tomorrow we will not put you on the waiting list. So if you want to come in tomorrow and we check that you have not paid the bonanza fee, so we will put you at the waiting list. So it's very important. Thank you very much. So any other question?
I still have a question. I'm not done yet. Yes. I'm not done yet. When is the exam coming up? When?
No, when the exam we can schedule the exam at any time after the training.
Okay.
So what you will finish, one of the requirements is that when we will flag it on the last day, when you finish the training, before you enroll for the exam, there is a technical paper you need to write.
Okay.
You have to write a technical paper and also submit the technical paper. When you submit the technical paper, that is when they will give you go ahead to go on. They will not send you an email and acceptance to go and schedule your exam. So you will not go and schedule your exam. So the technical paper will also be graded. You can fill the technical paper and pass the CCP. You can pass the CCP and fill the technical paper. So I will show a sample of the technical paper to you on the last day.
Okay, thank you, sir.
Yeah.
Hello, Doc.
Yes.
Okay. Hello, Doc. Okay. Well done. Good evening.
Thank you.
Yeah. So I look at this training as like a preamble also for those that knows about CCP or those that are just trying to pick interest in costing. Yes. So I look at this as like I said, a preamble that supposed to be followed with further training for especially before one can venture into the at least taking the exam.
Yes.
Exam.
Yes.
Is there any follow-up also, like from your end or wherever?
Yes.
And I know, like PMP now, I know when after a training like this, like a mock exam comes up for one to really ascertain that, yeah, this is how it looks like before one venture into the rate thing.
When we finish this training, there are some material I have not shared for you. There is a material properly from CCP Direct. The one I'm using, the one I've shared for you people now is the PowerPoint I prepared. There are material directly from CCP. The material alone is $100. So, but I'm going to share the material for all of you. The material has there are 3 textbooks. There are one that is called Exam Guide. That one discusses each chapter of the CCP as likely exam questions. So when they will discuss chapter 1, at the end of the chapter 1, they will set about 20 questions under chapter 1. They will discuss chapter 2, they will set about 20 questions. So all those ones will guide you as a way of doing it. And when we finish, when we finish the training and those who want to write the exam, we can create a WhatsApp group for you people, and we will also follow you up. If you have any question, you call us, we relate on the WhatsApp group. We guide you till you write the exam and pass.
All right, thank you for the response.
Okay, thank you very much.
Okay, Doc.
Yes.
Please, are we getting the materials as promised earlier?
Yes, I also said it now. I'm going to share the materials.
Okay, thank you.
Hello, Doc.
Hello.
I want to know if the material will be sent to us today, so that at least those of us that
what I will do, I don't know those. If you know you have not received the material, and I guess you have my phone number. Let me put it on my chat box. I think I've sent it to a lot of people. But if you know you don't have the material we are using for this training now, then chat up with me after the training. I will send it to you. But the remaining material, which is the CCP material itself, when I am sharing the certificate, this training is being recorded. I will share the video for the 3 days. So when I'm sharing the videos and the certificate of attendance, I will share those material along with you people. I promise you, I will share everything with you.
Yeah, hello, Doc. But Doc, there is another material you used today that is not among the ones you shared earlier.
Okay, that should be a Z sheet.
I don't know, but you pointed out because I just
it's an Excel sheet.
Just printed the material you shared for the slide.
What happened is that why I'm swapping in between them is that I have a material. The one I shared with you earlier is the full material. I prepare for the whole training. But when I want to train NLPC, it was physical. I break that material down into day 1, day 2, day 3, day 4. So those day 1, day 2, day 3, instead of sharing them individually with you, that is why I shared that single one. Everything is still in that single one. Okay. So everything is still in that single one instead of sharing it day 1, day 2, day 3, day 4 for you people. So everything, all the material that I'm swapping in between, everything is in that single PDF material I share with you people. I think it's only the Excel sheet. I will check the Excel sheet. If some of them are missing, then I will also add it to a singular Excel sheet. If you see the Excel sheet I sent to you, we have a lot of worksheets under it.
Yeah.
So I will check the one we used today, and let me see if anyone is missing. So I will add it, and I will send it across to you people. But when I'm not the real material from CCP, which is about 3 textbooks, I will share all of them with you with the recorded video and the certificate of attendance. So I've shared my number 0349980. If you know you have not received those material we are using today, after this training, just chat me up so that I will send them across to you. For those who have paid though. So any other question so that we call it a day?
Okay, thank you, Doc. See you tomorrow.
Uche, do we have Uche in the house also?
Yeah, Engineer Sunday, I'm here.
Okay, do you have anything to say?
Thank you so much.
Yes.
No, all I would say is it's been a good time this evening. All of us will keep learning. And as you write, those who want to be in the class tomorrow and are not paid should endeavor to effect their payment. And let everybody be assured that the program is being recorded, that my videos and every other thing will be shared to them. Thank you.
Okay, thank you very much. So see you people tomorrow by 3 p.m. as usual. Thank you very much and have a good day.
Bye.
Bye.
Bye. Bye. You.